Right now, silver is sitting at $63 to $65 an ounce. And to most people, that number means nothing. They glance at it, shrug, and move on. But here's what they're missing. That number isn't just a price, it's a signal. And if you understand what's underneath it, the mechanics, the institutions, the historical pattern playing out in slow motion, you'd realize this isn't a moment to glance at. This is a moment to pay very close attention to. Because the last time this setup existed, the last time these exact forces converged at once, silver didn't just move, it exploded. Stay with me, because by the end of this, you're going to understand something most retail investors never figure out until it's too late. Credibility build. Let's start with what's actually happening in the market right now, because the surface level narrative and the underlying reality are two completely different stories. Silver at $63 to $65 sounds high to people who remember it at 20 or 25. But adjusted for inflation, factoring in the monetary expansion that's happened since 2020, silver is still massively undervalued relative to the amount of new money that's been printed into existence. Since 2020, the Federal Reserve expanded its balance sheet by over $4 trillion. Global central banks collectively added more liquidity than any point in recorded financial history. And when you print that much money, hard assets, real, tangible, finite assets, don't just go up in price. They reprice to reflect a new monetary reality. Gold has already begun that repricing. At over $3,000 an ounce, gold is screaming something. But silver? Silver is still in the early innings of its own repricing. And that gap between where gold is and where silver sits tells a story that institutional traders have been quietly tracking for months. Most people don't understand this. Here's what most people don't understand about silver. They think of it as a cheaper version of gold, a poor man's precious metal, something you buy when you can't afford the real thing. That framing is not just wrong, it's dangerously wrong. Because silver doesn't behave like gold, it behaves like a compressed spring. Gold moves steadily, silver waits, and then when it moves, it doesn't follow gold, it surpasses it. In percentage terms, every single major precious metals bull run in modern history saw silver outperform gold. Not by a little, by multiples. In 1979 and 1980, while gold surged roughly 300%, silver went up over 700%. In 2010 and 2011, gold rose approximately 170% from its lows. Silver rose nearly 500% in the same window. So when you look at silver today at $63 to $65 an ounce, you're not looking at a metal that already ran. You're looking at a metal that historically lags, then detonates. And right now, the conditions for that detonation are not theoretical. They are building in real time. Build tension. Let's talk about what's actually driving this. First, the industrial demand story has fundamentally changed. Silver is no longer just a monetary metal or a jewelry commodity. It has quietly become one of the most critical industrial inputs in the modern economy. Every solar panel requires silver. Every semiconductor requires silver. Every electric vehicle contains silver contacts. Every AI data center being built right now, the infrastructure powering the artificial intelligence revolution that everyone is talking about, is loaded with silver-bearing components. Global solar installations are expected to consume a record amount of silver this year alone, crossing thresholds that were unimaginable a decade ago. The Silver Institute has projected structural deficits for multiple consecutive years. That means demand is outpacing mine supply, not by a little, by hundreds of millions of ounces cumulatively, and that deficit doesn't resolve itself overnight. Silver mines take years to develop. New supply doesn't appear on demand. So while the industrial world is accelerating its consumption of silver, the physical supply cannot keep pace. Second, let's talk about what's happening on COMEX. The registered inventory at COMEX, the silver physically available and ready for delivery, has been declining. The ratio of paper contracts to actual deliverable metal remains at levels that historically have preceded massive dislocations in price. When institutions and sovereign buyers decide they want physical metal, not paper promises, the mechanics of that market get very uncomfortable, very fast. We've seen that movie before. And the setup today rhymes uncomfortably closely with moments that preceded historic short squeezes. Third, central banks. For decades, central banks held gold and dismissed silver. But that dynamic is shifting as nations in the global south begin diversifying out of dollar-denominated assets. The de-dollarization conversation isn't fringe anymore. It's happening at the IMF. It's happening in bilateral trade agreements. It's happening in the sovereign wealth fund allocations of countries that are watching U.S. debt spiral past $36 trillion with no credible path to stabilization. When the confidence in the reserve currency erodes, and confidence is the only thing backing it, hard assets become the last line of financial defense. Smart money versus weak hands. Here's where the psychology gets important. Because every time silver has set up for a major move, the pattern has been identical. Weak hands sell into uncertainty. They see volatility, they see short-term noise, and they interpret it as a reason to exit. Smart money, the institutional players, the macro funds, the sovereign buyers, they do the opposite. They accumulate during the quiet. They load up when retail sentiment is mixed and confused. And then, when the move happens, it happens fast enough that the people who waited for confirmation are already late. Right now, silver is at $63 to $65. It has corrected from recent highs, and in that correction, there's noise. There's doubt. There are people asking whether the bull run is over, and that doubt, that uncertainty, that is exactly the environment in which accumulation happens. That is the environment that precedes the next leg. The question isn't whether silver is going to move. The question is whether you'll be positioned before it does or after. Risk section. Now let's be honest, because credibility requires it. Silver is volatile. Anyone who tells you otherwise is selling you a fantasy. It can drop 20% in a matter of weeks. It can frustrate you for months before it rewards you. Macroeconomic timing is notoriously difficult. If the Federal Reserve engineers a hard landing and industrial demand collapses in a genuine recession, silver will feel that pain. If global solar installation targets are rolled back, if the energy transition slows, if geopolitical stability somehow returns overnight, the tailwinds weaken. These are real risks. They deserve honest acknowledgement. What you're evaluating here isn't a guaranteed outcome. You're evaluating a probability-weighted setup in a market where the structural forces, monetary, industrial, geopolitical, and psychological, appear to be aligning. Appear to be. Nothing in markets is certain, but the data, the history, and the mechanics suggest that the asymmetry here favors the patient. Visualize the future. Let me ask you to do something uncomfortable. Imagine it's 2 years from now. Global solar demand has continued compounding. The AI infrastructure build-out has consumed billions of ounces of silver in electronic components. COMEX registered inventories hit a critical threshold and a major delivery squeeze occurs. The Federal Reserve, facing a debt spiral, pivots to fresh quantitative easing. The dollar index breaks below a critical support level. And silver, sitting at $63 today, crosses 100, then 120, then beyond. That's not a fantasy pulled from nowhere. That is the logical outcome of forces that are already in motion, forces that are already measurable. The only variable is time. History shows that when precious metals markets move in that environment, they don't give you a graceful entry. They gap up. They open at prices that feel impossible. And the people sitting on the sidelines, waiting for certainty, waiting for confirmation, waiting for permission, find themselves watching from the outside as the market reprices everything they delayed. Here's the question I'll leave you with, not as a recommendation, not as financial advice, but as a philosophical question for anyone who takes their financial future seriously. If the institutions know what's in the ground, if the macro forces are documented and measurable, if history has shown this pattern more than once, and if the industrial demand is not speculative but structural and growing, then what does it mean to wait? At $63 to $65 an ounce, silver is not asking you to speculate. It's asking you to pay attention. The market is sending a warning. The question is whether you're listening. Drop a comment below. Do you think silver breaks $100 before 2027? I want to know where you stand. And if you found this analysis valuable, the algorithm needs your support right now. A like, a share, a subscription keeps this research coming. We'll see you in the next one.